So back on August 5th, the VIX spiked. It was actually over 50 intraday. It ended up closing over 38. That's quite unusual. What is even more unusual is the fact that it fell down to sub 15 on Friday and is below that level as we speak. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So I know that on the last live stream I mentioned that we would probably take a look at a couple single stocks ahead of their earnings. We have a little bit of time to delve into that, but over the course of the weekend I was contemplating the VIX's close on Friday. It closed around 1480. This morning it was trading around 1470 that was in the morning. Let me see where we ended up finishing out the day. I was looking at some other things here. So we wrapped up. So I'm getting conflicting information. What did you just say to me, Brad? So right now I'm taking a look at the VIX. So quick point of order. The VIX will get published. It's actually live ticking outside of regular market hours. And part of the reason for that is that the VIX index is calculated off of a 30-day strip of SPX options. And SPX options hours, trading hours, fall outside of regular equity market trading hours. Now, I've said this before, so we're just going to go into this a little bit, and then we're going to delve into potential trade here and how it works. And it's a more nuanced trade than the sort of set and forget typical kind of things that you're going to hear from, call it pundits like myself talking about options. It's going to be a little bit more option-y or volatility based. But I hope can explain this in a way that is digestible. So right now I'm seeing it actually about 1460. So the VIX index is calculated off of a 30-day strip of options. What's a strip? A strip is just a big series of options. The way you can go to the SIBO's VIX calculation methodology website, you can just Google that, just SIBO VIX index calculation, and it'll lead you there. Not really important to get into the math of that, but I do want to just make a couple quick points about it. The VIX index is always looking 30 days out from the moment that you're observing it. So it's like a weather forecast. It's just predicting volatility, or at least giving us a single number to explain what the implied volatility from SPX options is. The reason that that's important is because you cannot actually trade spot VIX any more than you can trade the weather forecast. If you could, then trading would be very easy. For example, if you lived in Colorado, you could always just short the 30-day weather forecast in July and buy it in January or February, because of course you're dealing with different time intervals. So the weather forecast is never the same. The VIX index is never covering the same period of time. Each day it's rolling forward by one day. So the reason that's important is that if you cannot trade the VIX, how then does one trade volatility? Options traders are always talking about volatility. How do you trade it? Well, there are some products. There are exchange-traded products that one can trade, such as VXX and others. You can go long or short these products. I have described in the past how these are not good investment products, generally speaking, because they have decay. But I thought what we might talk about today is how one actually goes about realizing volatility. How do you trade a listed option on an ETF like IWM or SPY or Diamonds and actually try to capture the volatility that its options are pricing, whether long or short? And then the second thing is, does one want to do that? And actually we can maybe address that part first. So let's get back to August 5th. So August 5th followed on two relatively high volatility trading days. I believe in the pre-market, The VIX was actually indicated above 60 at one point. It did trade over 50 intraday, and it closed over 38. Now, this is the first time we saw levels like that since 2020. So, we're talking pandemic plunge kind of stuff, not quite, but getting on, that kind of thing. Or GFC, Great Financial Crisis. So these are pretty extraordinary levels. How extraordinary are they? So the VIX index, we have data going back to the beginning of 1990. Not because the VIX index was quoted then, but because we have historical options pricing data, so we can use that data to calculate the VIX index going back in time. Only about 4% of the time in the last 35 years have we seen implied volatility levels for SPX options in that ballpark. So pretty rarefied air. Fast forward from the 5th to last Friday, the 16th. Last Friday was the 16th, right? Yeah, that was the 16th. And now we've got the VIX at 1480. So that means that SPX options are implying volatility in the neighborhood of 14.8% annualized. And as I looked at that, I thought, boy, that's quite the mean reversion. So what is mean reversion? And volatility is a mean reverting process. Mean reversion simply means that you have a process that tends to fluctuate around some mean level. Volatility rises during periods of market tumult. This can be true of an individual stock. It can be true of an index, a commodity, or whatever. And then eventually, the market figures things out, things settle down, and volatility drops. Similarly, you can have periods of extraordinarily low volatility, where things just don't seem to be moving very much. 2007 was a period of very low volatility. 2017 was a period of exceptionally low volatility, particularly towards the tail end of the year. But then oftentimes something comes along. It could be some kind of severe earnings or economic disappointment or a geopolitical event, something like that, and volatility suddenly comes back. And so when it's very low, we expect it to eventually rise. And when it's very high, we expect it to eventually fall. What was occurring to me was that a fall from 50 to sub 15 in 9 trading days felt like a very big move in a very short time. And to give that some perspective, I think maybe what we can do is first take a look at this chart, which I will try to expand on my screen, and hopefully you all can see it. So this is a 35-year history, or almost 35-year history. We don't have exactly 35 years worth of data, but it's approximate. 35 years worth of data for the VIX index. And we can see that there were relatively few spikes that got above 30. That's where my cursor is right now. And very few that got above 50. Now, if you go all the way over here to the right, you can barely make it out, and probably on your screen you can't see it because it's, a thin little sliver. But we indeed got up to this sort of 40 level, and we've subsequently fallen back. So we were just talking about mean reversion. What is the mean? So the mean for the VIX over the entirety of this period is just under 19. All right, so you can see this little hash line here where my cursor is 20. And the mean level, let's just call it 18, 19, in this neighborhood here. So it occurred to me that for the SPX options markets to suddenly be expecting forward volatility to be sub 15 after these big shifts in the market struck me as odd. And maybe visually, as you look at this chart, it'll strike you as odd as well. Because one of the things you will see is that when you get these big spikes in volatility, they can be very short-lived, and you can see that volatility can fall, implied volatility can fall thereafter, sometimes quite sharply, as it did in the GFC. That's this period here, you can see. Or during the pandemic plunge, that's over here where my cursor is. Let's see if I can make that visible. So that's not so unusual. But having it fall down to sub 15 so quickly did strike me as unusual. And so that got me thinking about something else. What was that? Well, how often did realized volatility thereafter actually turn out to be that low? So let me phrase that differently. If the VIX spikes above 35, as an example, how common is it that suddenly realized volatility for the S&P falls to a below mean level, below mean VIX level? And so I created this little spreadsheet, and that's the reason I'm showing you here instead of showing it to you on the Bloomberg terminal, so that we have some sense of it. And there's some numbers over here on the left, and if you can't read them, I'm going to recite them, so we're not going to get too worried about that, but I'm just going to do a little bit of filtering here. So, and let me just blow this up. And actually, I'm going to start sorting this so that we can see. Let's take this, we'll go to column E here. So that's going to be, and I'm going to explain what these things are, so we get a sense of it. Okay. So this column here, and let me blow this up. I'm going to see what you guys are seeing because it's going to be very hard to make this out, I know. So I'm going to make this as large as I possibly can. And it's really only these top numbers that are important to us. Okay. So what are we looking at here? Over the last 35 years, I've basically just selected those days when the VIX closed above 35. So it was 38 and change on August 5th. So what happened? And these columns, C, D, and E, are reflections of how the SPX had been behaving and ended up behaving thereafter. So obviously the historical vol, which is in column C, is only partially important. So if the VIX gets above 35 on some day, how it behaved in the 30 days leading up to that event may or may not be that important to us. But what is more interesting to me in terms of thinking about how options are priced is whether or not those forecasts of volatility were prescient in any way, and how volatile the market proved to be thereafter. So that's what we're actually looking at in columns D and column E. And I have ranked this first from lowest to highest. The 30 days realized volatility for the S&P when the VIX closed above 35. What was the lowest 30-day subsequent volatilities that we saw from that day? And we can see that after the pandemic, we had this pandemic spike in late February, and there was a period thereafter where it was 15.3 round numbers. Now remember where it was on Friday, 14.8, so lower than this. And from there on, we just see higher and higher numbers. Okay? Well, we are now 11, 12 days removed from all of this. So how do these numbers look if we advance the clock by 2 trading weeks? Well, that's what we have here, the next column over. And these minimum numbers, so what I'm doing is I'm actually just taking a rolling window, looking out in time and just saying, how low did it get? At any point, how low did it get? And now we can sort by that. So this is really thinking just how possibly cheap could realized volatility be after you've had such a meaningful disruption as we have had. And, the truth is that the number of data points are remarkably remarkably low. Okay. In fact, actually, I'm going to just tell you, I'm just going to skip to the good part. So it turns out that there are only about 5% of all observed instances, which themselves are only 4% of all trading days since 1990. About 5% of the time did we see volatility anywhere close to these kinds of levels that the VIX is now implying. 95% of the time it was higher than this when you look ahead. And that should make some intuitive sense to us, because if you think about it, what caused the VIX to spike in the first place? Concerns about the yen carry trade, concerns about what the Fed might do, concerns about the election, concerns about the pandemic, concerns about the failure of Lehman Brothers, concerns about the flash crash. All of these things were events where we saw big spikes in the VIX, and all of these things, other than the flash crash, essentially didn't resolve straight away. People became more complacent, or they got comfortable with it, or the yen carry trade went back on. But the fact is that high VIX level represented concerns about market fragility. It isn't that easy for those concerns to dissipate so completely. Just like dropping paint into the water, or aftershocks after an earthquake, or your car goes over a bump at speed, there are dampening effects that mitigate the repercussions thereafter, the oscillations, the bumps. Otherwise, your car would pogo all the way down the road, I suppose. As, you know, there are shock absorbers of sorts. And investors have become quite complacent in this area. They have gotten to a point where we've learned to buy the dip. Every dip, you buy it as quickly as you can. And of course, this is supported by the notion that we've had aggressive monetary and fiscal policy every single time there's a little bit of a bump in the road. Like helicopter parents, policymakers come riding in to the rescue. But we still see that market fragility exists nevertheless, as the, you know, whether it was the yen carry trade or whatever, that took place. So if we know that when you get this kind of a spike in the VIX, above 35, that it is highly unusual to have a period of realized volatility below 15 or so for the future that the VIX is currently looking at, the question then becomes, well, how does one take advantage of that? So is it VIX futures? Is it buying puts on your portfolio to protect it against further downdrafts? These are things you could do, of course. These other exchange traded products, of course. But actually what I wanted to go over today was what happens when you simply buy options on an ETF and hedge them once a day, delta neutral, so that you essentially buy an implied volatility and then capture realized volatility. And so what I did was I went back to the end of June and a period when we had probably similar levels of volatility as we are observing today. And imagine that you bought a 30 delta put that expired at the end of August. So these options that I'm about to show you are still going even now. So you buy a 30 delta put and a 30 delta call that expire, give or take, in 60 days. And then hedge those things delta neutral. What does that payout look like? How do you realize volatility? And this is what options traders, volatility traders, are doing all day. And I thought this would be kind of a simple way to explain it. So here we go. And again, this is kind of looking like the Matrix, but bear with me, and I think we're going to sort of understand what's going on here. So on July 1st, somebody who wanted to do this would have purchased, we can do this just, you know, one at a time, so we're going to actually go through the P&L. Now bear in mind, this P&L is not including commissions and things like that, but there are platforms actually that allow you to trade effectively commission-free, particularly if you're doing things like market orders. And I'm going to make an assumption here that at the end of every day, you would put on a market on close order to adjust the deltas in the way that the options position would prescribe. So what would happen here? So on July 1st, you would have purchased one SPY August 30th 563 strike call. That option cost $3.89. 389 because each contract represents 100 shares. And you would have bought one August 30th 535 SPY put for $4.99. So your total outlay on July 1st would have been $888 in premium. Now, as it happens, I did this deliberately, those two options, the call and the put in this strangle, that's what this is. You buy out of the money put, you buy an out of the money call of the same expiration with the same underlying, that's a strangle, is delta neutral because the delta of the put was negative 0.292, about 30 delta, and the delta of the call was 0.292. Add them together, negative 292, positive 292, 0. So that's what you do on the very first day. Okay, so you bought it, you laid out $888 in premium. The very next day, and most of your brokerage platforms will provide deltas for you, so you're able to do this math pretty easily. The next day, SPY was a little bit lower on July 2nd. And as the end of the day approached, the downside put was negative 35 deltas. I'm sorry, the call was now 30. I guess the SPY went higher. My mistake. Oh, yes, here it is. I've got the SPY prices. I'm sorry. So SPY went higher on the 2nd by almost $4, $3.65-ish. So the call delta went up, the put delta went down. So now you find yourself in a situation where you're carrying deltas. We want to hedge this delta neutral, remember, right? So in order to true that up, we put those two deltas together, we get 10. So you would put in a market on close order to sell 10 SPY that day, which you would sell at the closing price. So I'm reflecting that sale here in column H and the proceeds of that sale here. So you'll notice that whenever you sell stock, it's going to be a positive number. Whenever you buy it, it's a negative number. Next day, on the 3rd, SPY goes higher again, this time by almost another $2.50. You're now a little bit longer. So your sale of stock the preceding day turned out not to be great because you sold 10 shares at $549.01. Stock's now $551.46. But now you need to sell another 7 shares. Notice the value of the options position over here. We can see that it's gone up a little bit. All right? So this is the way it goes. Every single day you calculate what the delta is of your options position, and then you true it up with stock so that you are delta neutral. When the stock rises, you're going to find yourself selling stock. And when the stock falls, you're going to find yourself buying it back, or if it falls falls low enough, you'll actually end up getting long, and so on. And actually, we can see that. So I'm keeping track in column J here of the equity hedged position in shares over time. And we can see that you get short stock, as many as almost 50 shares here. We can see short 49 over here. And actually, let me put the dates into this chart. That'll probably make this a little bit easier to see. So I'm going to do that now. And that didn't help because it's not formatted as a date. There we go. So we're just going to get back to this, and maybe I can make this a little bit prettier, and I'll blow it up some. So this is your stock position over time. Okay? So as the stock rose, you would be selling stock to maintain that delta neutral position. As it falls, you're buying it back. Then you sell a little bit more, then you buy it back. Now you're long stock. Going back to the August 5th, this shouldn't come as a surprise. The market had fallen considerably, so you actually bought stock down there to maintain that delta neutral position. And then as the market rallied, you ended up selling it off. Okay? So this is the way that options traders actually manage their book. We call this delta hedging or trading your gamma. Basically, you're changing the stock position just to make sure that you basically have a delta neutral position all along. Now I'm going to get to the punchline in all of this. Had you done this, had you bought that strangle on July 1st, you would have spent $888. And that strangle, we've seen a lot of volatility since, is only worth $354 now. But that's not the whole story, because you would have been buying and selling the stock around this to maintain that delta neutral position. And the proceeds of that were $1,649. So between the profits that you made trading the stock, selling it as it rose, buying it as it fell, combined with the value of the options position, you actually would have made a profit over the course of, how many trading days is this? 35 trading days on an $888 position in terms of premium initially and hedging it regularly. You would have made a profit of $1,115. And I bring this up because I was also being asked by a friend of mine who is an institutional investor who has some high net clients. What do we do? What do we do here if we want to be able to play offense? Playing offense means being queued up to make an investment into equities on a pullback, and also to capitalize on an anticipated increase in volatility. And I didn't actually propose this trade. I had something a little bit different in mind for them. But it occurred to me that this is not something that gets discussed very often, if at all. How do you actually trade vol? So how would somebody do this now? Well, you could do effectively the same thing. Look out, call it 60 days, and find, and actually I should use, for simplicity, because I realize that in this context probably Bloomberg's not going to be the easiest way to illustrate this. I think options play is going to be much easier, so we'll do that. Look out about 60 days, find a 30 delta call, find a 30 delta put, in SPY, buy each, delta neutral, and then each and every day hedge this. Now you can do this with SPX as well, if you're so inclined. So using SPX index options, NDX if you're trading the NASDAQ, Russell, or you could just use SPY, Qs, or IWM. There are reasons why I tend to prefer the index side as a mechanism for doing this, and that is that it's European, it's cash settled, so you never end up with a circumstance where you have to contend with assignment or early exercise. And both of those are considerations. So SPY pays a dividend. If it migrates significantly away, your long calls, you may end up in a situation where it would be optimal to exercise those early. And I don't really want to get into the complexity of that. Not a concern when you trade SPX. But it's not a huge, huge thing to do. So we're going to just quickly do this now. So 60 days is October 18th, regular way expiration. And we're just going to find a 30 delta call to buy, which it turns out is, well, 577s are 31 delta, 578s are 29. I'll just pick the 29 delta, so I'm going to round down because that's also actually what I did on that last example. And now I'm going to do the same thing here. I'm going to look for a 30 delta put. See if we can find one. There's 30. Now there's 29, so that's effectively delta neutral. And here's what we get. All right, so you're going to observe that if you were using options play, that this isn't going to score that well. And it's going to show probability of profit that's 36.5. And why is that? It's because this is assuming a set it and forget it approach. So you buy that strangle. What are the chances that it goes through that upside call, in this case the 578s, by the 10.5 bucks or thereabouts that you spend, right? So this needs to get close to 590 in SPY, up to 5,900 in the SPX, if you just set and forget and didn't do this delta hedging that I'm talking about. The probability of that, not that great. Or alternatively, the S&P would need to fall by a sufficient amount that it would go through your put strike by more than the total premium spent, which means below 547 by 10.5 bucks. So now we're talking about 535-ish in SPY is where you'd begin to see profits. But as we could see in this analysis, if you're delta hedging, you are going to get a very different kind of P&L. You're going to realize volatility. That's what you're doing by trading those deltas. So you're going to be experiencing decay, but it's going to be offset by your scalping of these changes in delta. So now the question is, seems like kind of a neat trick. Why don't you recommend this all the time? Just hedging this way. Well, the reason is because in general, implied volatility for index-related products and their kissing cousins, which are the ETFs that track them, so S&P options versus S&P, NASDAQ options versus the NASDAQ itself, SPY, Qs, etc., that there is something called a volatility risk premium, which means that the options are usually priced at least fair or slightly higher than they experience. But that brings us back to where we began this conversation, that as you look at this, what we see is that, in fact, it is really rare for realized volatility to get down to the levels that we're seeing in what the VIX is implying. When you have a spike in volatility as sharp as the one we experienced, 30 days hence, 45 days, 60 days, what are the chances that you're getting down in that 14 realized volatility, 10? You know, we've actually seen realized volatility get substantially lower than that. I was talking about 2017. I think realized volatility in the S&P at that time was mid-single digits. I'm talking about 5%, 6%. But here's the thing. Even if it falls to 10 or 8, if you buy 14, 15 vol and you realize 8, all of the extrinsic premium in that strangle that you bought could go away, but you're still hoping to have clawed back 50, 55, maybe 60% of the premium. So what is your risk really? That you lose all the premium you spent in this situation? Well, no, you will definitely, the market's not just going to freeze. It's not going to stop right here. So a zero isn't what comes out of it when you put these types of trades on. You don't end up with a zero P&L. And statistically, the chances that it ends up below 15, at least over the last 35 years, really quite low. Now, you could say 350 or so data points, because that's what we're dealing with, right? So over 35 years, how many trading days did the VIX actually close above 35? It's about 350, right? So pretty rare. We're talking about 4% of all trading days over a 35-year period had implied volatilities looking 30 days out that were consistent with what we are seeing here. And only 5% of the time would you have been a loser buying 15 vol. Contextually, so here we are 10, 11 days hence. I just have a hard time believing we're completely out of the woods. We've got the DNC coming right up. September is traditionally a more volatile month. People often think about October because we've had crashes in October. The crash in 29 was in October. The Lehman Brothers thing was in October, I believe. So either October, I think it was. But September is typically a period of elevated volatility as well. It's right in the hunt there. And we have an FOMC meeting. Everybody's forecasting a cut at this point. Inflation data supports it. Employment data supports it. That's the common view. So Will volatility come crashing in because the market gets what it expects? Or does the relatively smaller chance that they hold off or that we get some other negative data point which steers people in the other direction create some risk? We have the election. This is going back and forth. And as many of you viewing will know, I'm not enamored of discussing politics on this, because if you were interested in that, you probably wouldn't be tuning in to see me. But I, of course, do, as many of you do, have a view on policy pronouncements, particularly those that are, in my view, nothing short of dangerous. So, you know, if you're a Kamala supporter, you might want to cover your ears right now. But if you don't, I'm just going to tell you, this price gouging business that she's come up with on food prices is really dangerous, right? So this is not helpful. It's not constructive. I have seen people posting about the record profits at outfits like Kroger, which is just astonishing to me, because the profit margin at Kroger, which employs 400,000 people, and not the world's best paid employees either, and feeds God knows how many millions, the profit margin at that company is about 2.2%. 2.2% net profit margin. And if that's a price gouger, and this is a company that has a lot of shareholders, it has a lot of public pensions as shareholders. So someone might say, well, they've got $4 billion in profits. Okay. That's less than $10,000 per employee. They feed millions. What exactly do you expect investors to make? 1%? 0.5%? 0? People are supposed to just invest their money and get nothing back? Much of it is already being taken. It is inane. It is dangerous. And it speaks to an astonishing economic illiteracy. And I mention all of this because these are hazards for investors. If you are an investor in Kroger or Albertson or Safeway or, God forbid, Costco, okay? So Costco doesn't, why don't we take a look at Costco margins right now? But Costco is trading 46 times earnings, I believe. Okay? And let's just take a look at what if they, what if folks start saying, oh, well, Costco they're making a bigger profit margin, not exactly a huge profit margin, by the way. So they're making a bigger profit margin than Kroger is. Look at this. They're forecast to make 2.8%. So 2.8%. So for every $1 million in revenues, they're going to make $28,000 in profits. What if they end up being, that's substantially bigger margin than Kroger. So what is going to happen to your stock that's trading, let's see, where are we? On a price to earnings basis, we're just going to get, on a trailing, I'm going to go trailing and forward. We're going to get rid of the price because that clouds the issue. Look at it, 54 times earnings. What happens to your company that you're buying at 54 times earnings, which, by the way, is a multiple I can't get my arms around for those of you who are in Costco. 54 times earnings, if all of a sudden the administration is saying, it's insane that a grocer makes 2.8% profit margins. What should they then make? 1.4? So then you're not trading 54 times earnings, you're trading 108 because they're going to try to do things to curb your sales. So my point is, I'm not saying this is going to happen because I think there's been, fortunately, I'm not the only one who's critical of this. The Washington Post has come out with editorials that are critical of it, even the New York Times and some others. Folks who have traditionally leaned left are coming out and saying, this isn't helpful rhetoric at all, and it's not. But when you have policy prescriptions that increase demand, constrict supply, and chase businesses that don't really have extraordinary margins, you cannot feel like that type of talk is positive for equities. And, you know, I think that reasonable voices will eventually come into the fray, one hopes, regardless of who wins, because not every policy prescription from either candidate, frankly, is all that great. But the most recent ones are not good for equities. They just aren't. And if we hear more of them and we see rising poll numbers, reasonably, you should anticipate some volatility. Below average volatility is not what we would expect. So could you lose money buying strangles and hedging them? Of course. Is it likely? Well, the historical data suggests that that's not very likely. I mean, in only 5% of the instances or so would you have actually done poorly by buying volatility at these levels and hedging it in the way I just described. So just as I looked at it, I thought this is really unusual, and I wanted to obviously talk about single stocks, which I usually do, but I just kind of felt like this was important because I don't know how many opportunities are going to be. I don't know that this situation is going to just sit here like this for days to weeks. I suspect it isn't. I don't think it's going to outlast Labor Day. So take that however you will. And with that, I'm going to move on and take some questions. And I realize that I've been going on for quite a while, and so I appreciate your patience with that. Okay, so Kirk, Mazzie, which one is it? Mazzie? M-A-Z-Z-I-E. I'm going to say, I don't know, but I'm going to say Mazzie for now. Or Mazzie, how about that? I think, so good afternoon. Cava earnings out, coming up Thursday, 93.50 is resistance, support, resistance and support, 93.5 and 100 is an exhaustion spot. It must go through. I calculated a move, an expected move of about $4 on earnings. Okay, well, let's just take a quick peek at Cava. So the first thing I'm going to do is just see what is Bloomberg forecasting as the implied move. So they're going to be reporting Thursday, as you point out. Implied move, according to Bloomberg at least, about 10%. Not a lot of operating history to work with. And again, for those who are, playing along at home, and I don't know that it really makes much difference to really figure out the one-day earnings-related implied move if you have weekly options, one day versus until the end of the week. The event's going to take place on Thursday, and the options expire on Friday. So the stock's about $100 right here and now, and the at-the-money straddle, so combining the 100-strike call, the 100-strike put, mid-market, we'll call it 5.5 versus 525, so 1075, 10.75% a spot, higher or lower, is what the options market is implying. Take a quick peek at the chart. Wow, well above the 150-day. That looks like, other than this little swoon in here, it actually looks pretty good. Let's now do what I've been doing lately, which is taking a look at, this is the time that everybody gets to pick their poison on technical analysis. Whatever technical tool you happen to use, there's a decent chance that a version or derivative of it is included here. And as we can see, so 4 technical indicators at the moment don't necessarily hold a position. So Bollinger Bands, RSI, stochastics, and trading envelopes. It looks like closed out of any longs or shorts that they may have indicated based on sort of a standard template of their use. Of the remaining technical indicators, and again, I say this all the time, but this buy and hold, just ignore that. It's put in here for reference, so don't pay any attention to that. But we can see that of the remaining technical indicators, all but 4 would be long here. So, the question I think you were asking is, what then? What would the trade idea be? So let's just pull up, because I think the Options Play app is usually the easiest way to illustrate the construction of ideas, because you can do it really quickly. So we will do that. And I think I had it up already. I must have hid that browser window. So we're going to just pull this up. How's my battery doing? I will lose my ability to hear and see what's being displayed. But I'm going to wait until the new iPhone's out before I start fiddling around with that. Or I'm setting up another desk operation, so I'll have sort of a better setup than this one. Okay, so first things first, options premiums are pretty high. The implied move is as big or bigger than what it has experienced over the last 4 reported quarters. At least we don't have more to work on than that, unfortunately. I pointed out that I feel like it's pretty extended above that 150-day. So that's not necessarily a bearish thing, but pretty tough to go out and reach it when it's as extended as it is right now. So my suggestion would be, if you are inclined to make a bullish bet, would probably be to use something like a call spread, such as this. I'm just looking, by the way, at regular way, which is, you'll notice I default to this, but there's no reason you need to necessarily. There are benefits to using shorter dated verticals, and that is that, well, oftentimes they're going to cost you a little bit less if you're doing it as a debit spread, but there's something else, which is that if the stock rockets higher, and this does have weeklies, it's going to actually go to the full value of the spread if it does happen to go up by, you know, that amount. So, you know, I oftentimes would just assume that you don't have to go out 30 days or more on these verticals if you don't want to, but I'm just using this for illustrative purposes. So, you know, buying the at the money or slightly, as it turns out, in the money calls. The par calls, 100 strike calls, about $8. The 120s, you know, around 190 bucks. We're just sort of keeping it simple here. So you're going to spend about $6.10. $6.10. Now, I've often said that I do like sometimes to try to get those debit spreads in and around 25% of the distance between the strikes if I can. This would be paying a little bit more than that. You might be able to get a little bit closer to those kinds of numbers if we adjust the strikes a little bit. But yeah, that's probably the way I'd be inclined to play it. And oh, by the way, if you use something shorter dated, so if we're just going to target earnings, let's just back this up, so we're going to do that. And I'm going to take the first out of the money call strike. You know, here what you might think about doing is just say, okay, if you're just targeting the move, look at the implied move and say, okay, this is essentially what I'm going to try to capture, right? So 101 first out of the money call strike to the 115s or 116 calls, something like that would work. Not that surprising that you can't get that 25% debit between the strikes, just it's a high vol name. But okay, so hope that helps. That's probably the way, not a name I'm involved with, but just something to think about. Aloha Mike says, FinWest, nice to be dialed into your live stream. with sunshine at 10 a.m., not 3 a.m. for a change. Well, that's right. Thank you for joining. And if I remember correctly, you are joining from overseas most of the time. So that's why and I think overseas and ahead of us, if my memory serves. So you're actually usually dialing in the very next day. But thanks for joining again. BABA keeps going up. Event through the quarterly earnings release wasn't that great last week, not to mention all the China macro headwinds and uncertainty. Thoughts on BABA in the money 85 October long calls. Thanks in advance. This is an interesting one. I have tried on multiple occasions. So yeah, maybe the earnings weren't that great, but it is worth pointing out that we don't usually see companies. We're never going to see U.S. companies trading at the kinds of multiples that you're getting out of this thing. This should not be in Chinese yuan. That's not helpful. Let me put this into dollars. So, I mean, just take a look at the multiples we've got here. You're dealing with something that is trading at high single digits, and top line growth, maybe not what one would expect. And of course, as you point out, they've got these but the thing is just terribly cheap. What's the problem though? And I've been burned on this thing more than once. The problem is with these Chinese stocks, you just never know whether Chinese leadership is just going to decide, whether you're Jack Ma or anybody else, that they are going to do something. And I'm getting a little bit of alert here because we're 55 minutes in. So I think 85 calls are a fine way to play it, probably the same way I would play it, especially given the fact that I just discussed, the fact that I think a lot of options premiums are reasonable. And here, that's what I'm looking at. So if you're seeing my chart right now, this is and I'm going to go to 2 month because, October is really 2 months away. So this is the comparison between historical vol in orange and the price of 2 month options in white. These are reasonably priced options. So if you're inclined to make a bullish bet, I wouldn't really overcomplicate things. I think the 85 calls are probably fine. My only problem is just that these stocks just disappoint me chronically. So there is that. Finwest, the VIX spike really helped me exit my UVXY position. Had been waiting and waiting and waiting. Yeah. So, Finwest, if I remember correctly, you had a vol trading background. And so curious to hear your thoughts on getting folks to try to trade vol, realized vol, by buying straddles or strangles. Now, I just said something that I'm glad I brought it up by mistake. So why do I use strangles rather than straddles, actually, in this context? The reason is because that way I have some exposure to the upside and I have exposure to the downside. If you just use a straddle, the volatility exposure is greatest when it's at the money. So Vega is highest when an option is at the money. So if I have an out of the money call option, I'm moving away from my put strike, so I'm losing Vega and I'm losing Gamma on that, but I'm gravitating towards Vega and Gamma on my upside call. Similarly, if the underlying declines, the same thing happens. And the reason I bring that up is because if you end up in a trend, you may want to do a delta reset by actually resetting the options positions, assuming that their implied volatilities haven't changed too much, because you want to continue to have that profile. We call that path dependency, when the sensitivity of the options that you're exposed to and that you want ends up going away because you're migrating away from the strikes where you hold those positions. If you get far enough away, there's no delta, there's no gamma, there's no Vega, there's no nothing. So, something to think about. Okay, Brad Holt. Mike, do options traders start this on a specific date, or do traders start when certain conditions exist? So you do this trade when you believe that options are just plain cheap relative to your expectations for volatility, because you're going to buy implied vol, you're going to buy realized vol effectively, and you want that number to be higher than you're paying for it. So implied is what you pay, realized is what you get. And, if you buy 35 implied vol, the market's really going to have to chop around for you to hedge this thing delta neutral and actually come out ahead. And even buying 15 vol doesn't always make sense because, as I pointed out, 2007, 2017, there were periods where we had single-digit realized. What I'm saying, though, is that you have to have the alignment of several things. You have to say, I think options prices are cheap. And I believe that there is potential drivers of volatility that I'm likely to experience between now and the expiration of the options I'm going to purchase. And I believe that's true. I think we have those drivers. I think the chances that we see 8 vol realized in the S&P over the next 30, 45, 60 days, not that great. I think there's enough out there to see to get bigger prints than that. So that was the thinking. Michael Anthony, Charlie Lima Whiskey. Oops, what were you asking me about it? Rebounding from the last 2 days of last week. Well, let's take a look. Yeah, this is there's 2 things about this. First things first. I'm not the only guy that talks about this, by the way. I'm sure if you've watched CNBC, you've heard Steve Grosso talk about it. Most traders usually have a 3-day rule. I think Karen Feinerman talks about it too. Waiting for 3 days after you have an event that causes a stock to break viciously as this one did. Why do we wait? Well, one of the reasons is that there are investors who are not that nimble. Institutional investors have to decide what they're going to do and then start to get into it. And frequently you just can't trade into or out of a position all that quickly. To put things in perspective, quite some time ago, a hedge fund I was at, we had $250 million position in Yahoo. You don't trade into those things in a day or trade out of them in one day. So you're waiting to see what institutions are doing, and then that flow will sort of reveal itself over the course of a couple of days. And it does appear that this one has rounded the bend a little bit. But I guess the question is, why is this the place where we want to be to place our money? Negative cash flow or no cash flow to speak of, no earnings to speak of, year-on-year forecast top line declines. It's getting cheap, but cheaper, I should say, $1.32 full year earnings forecast on a $32 stock. But is that really cheap? What is that, 25 times? 25 times that number? Yeah, it's cheaper, a better place to be than it was, but not the place I'd be really jazzed about. All right, Joe Kamen asks about NVIDIA going into earnings, and let's just take a look at that. So there's only one quick thing I would say about this. And this, I'm not telling anybody here something you don't already know. But we are, it's a ticklish situation. This thing, I think, has to prove itself up around this 140 level. That's about how much upside. I could see it running into some resistance there. There are people that bought and have been punished, and they often look, so there's a little bit of resistance there. Call spreads. I don't like to bet against growing companies. You guys have probably figured that out by now. And I don't short stocks that much, although I do sometimes get anxious about the market and volatility more generally. Implied one-day move, additionally, at 9.3%. A call spread I think would be okay For somebody who is feeling a little bit more daring, a call spread risk reversal, so buying an upside call spread going into the print, financed by a downside put, which is getting short vol going into the number. That's not normally something I would propose because it's kind of related to doing things like buy rights. Why would I do it here? It's because of that resistance up around 140, which I'm kind of guessing we're going to see. So if you think there's going to be resistance, then sometimes you would do a covered call, right, or a buy right. And that would be, kind of akin to what I'm talking about here. Okay, so that has chewed up an hour. And I recognize that what I was talking about with that strangle and hedging at delta neutral, this isn't open water swimming, but you're wading into the deeper end of the swimming pool, at least when we start talking about trading volatility in this way. Taking your options positions and hedging them delta neutral. But for those of you, particularly those who have customer portfolio margin accounts, dipping your toe into this, and it's going to really be illuminating, I think. And I encourage it in this environment because I think options just are not pricing a whole lot of trouble in. And, I don't know that we're completely out of the woods. I hope that helps you, and thank you all very much for watching. Like, subscribe, all that good stuff, and we'll see you back here on Wednesday at 4:15.